December 2025. The S&P 500 sits near all-time highs. Unemployment remains historically low. Corporate earnings keep beating expectations. And yet, 14 specific financial indicators, the same indicators that flashed before 1929, before 2000, before 2008, are all screaming red at the same time. This isn't about fear. This isn't about conspiracy. This is about a mathematical pattern that has repeated for nearly a century without exception. What you're about to see isn't prediction, it's recognition. And the clock is already running. Right now, somewhere in America, a financial advisor is telling a client that everything is fine, that the fundamentals are strong, that this time the market will keep climbing. That advisor isn't lying, he genuinely believes it, and that's precisely what makes this moment so dangerous. Here's a number that should keep you awake tonight. The total value of the U.S. stock market is roughly $60 trillion. The entire U.S. economy produces about $26 trillion per year. That means stocks are valued at 230% of GDP. The historical average is 100%. To return to normal, stock prices would need to fall by more than half. But nobody's talking about that. Instead, they're talking about the next rally. Linda Chen still remembers the exact moment she knew something was wrong. It was October 2008, and she was sitting in her kitchen in Phoenix watching CNBC on mute while her phone rang for the third time. Her financial advisor's voice was calm, almost rehearsed. "The market's down, but this is temporary. Stay the course." She had $420,000 in her retirement account that morning. 3 months later, she had $206,000. She never recovered. Today, at 67, she works part-time at a garden center because Social Security isn't enough. She stayed the course. The course destroyed her. What most people get wrong about market crashes is this. They think crashes happen suddenly without warning, like lightning from a clear sky. That's not how it works. Every major crash in history announced itself months, sometimes years in advance. The warnings were loud, they were clear, and they were systematically ignored by the very people paid to notice them. In 1929, economist Irving Fisher, the most respected financial mind in America, declared that stocks had reached a permanently high plateau. 1 month later, the market began its 89% collapse. In 2007, Federal Reserve Chairman Ben Bernanke assured Congress that subprime mortgage problems would be contained. 14 months later, Lehman Brothers was dead, and the global financial system was on life support. The experts weren't stupid. They weren't corrupt. They were simply doing what experts always do during the final stage of a bubble, explaining why the old rules no longer apply. And right now, in December 2025, the same explanations are everywhere. Marcus Webb made a different choice. In January 2008, he was a 42-year-old electrician in Cleveland with $310,000 in his 401k. He wasn't a financial genius. He didn't have insider information. But he noticed something that bothered him. His brother-in-law, who'd never held a steady job, had just bought his third rental property with no money down. If Tommy can get that kind of loan, Marcus thought, something's broken. He moved everything into Treasury bonds that month. His co-workers called him paranoid. His advisor warned him about missing the rally. By March 2009, while his colleagues had lost half their savings, Marcus had lost nothing. He bought back into stocks at the bottom and retired at 58. Same economy, same crash. Opposite outcomes. The only difference was pattern recognition. Here's what's difficult to accept. The current market isn't just expensive. It's mathematically impossible to sustain. The CAPE ratio, a measure that smooths stock prices against 10 years of earnings, currently sits at 39. The historical average is 17. The only times this ratio exceeded 35 were 1929 and 2000. Both ended in catastrophic crashes. We're now above both of those peaks. If you could see a chart of this ratio stretching back to 1880, you'd notice something striking every time it climbs this high. Imagine a sharp red line plunging downward within 12 to 24 months. The pattern has no exceptions. None. But this creates a puzzle, doesn't it? If the warning signs are so clear, why aren't markets falling already? Why are stocks near record highs when the math says they shouldn't be? This question has an answer, and that answer reveals something crucial about how crashes actually work. Something we'll examine in detail later. For now, understand this. Markets can remain irrational far longer than logic suggests, but they cannot remain irrational forever. Eventually, mathematics wins. Always. Patricia Okonkwo thought she was being smart. In 2021, the 44-year-old nurse from Atlanta had saved $180,000 over 15 years of careful budgeting. She watched her coworkers making money in the market and decided it was time to stop being so conservative. She invested everything in growth stocks and tech funds. By late 2021, her account showed $240,000. She felt like a genius. Then came 2022. By October, she was down to $130,000 less than she started with. She sold everything in panic. 2 months later, the market rebounded without her. Today, she keeps her savings in a checking account, earning nothing too traumatized to invest again. The crash hadn't even fully arrived yet, and she was already destroyed by the volatility that preceded it. There's a pattern hiding in plain sight. Every major crash in modern history, 1929, 1987, 2000, 2008, followed the same 4 stages. First, excessive optimism and rising prices. Second, warning indicators flashing while being systematically dismissed. Third, a triggering event that exposes the fragility. Fourth, cascading collapse as forced selling creates a downward spiral. We are currently in stage 2. The warnings are everywhere. The dismissals are everywhere. And if history holds, and it has held for nearly a century without exception, stage 3 arrives within 18 months. What happens next won't be random. It won't be unpredictable. It will follow a pattern as old as markets themselves. The only question is whether you'll recognize it in time. We ended part 1 with a pattern, a 4-stage sequence that has repeated before every major crash in modern history. Excessive optimism ignored warnings triggering event cascading collapse. We established that we're currently in stage 2. But understanding that a pattern exists isn't enough. You need to understand why it exists. What mechanical forces make this cycle inevitable, and why can't governments, central banks, or regulators simply prevent it? The answer lies in how modern financial systems actually work. Not how they're supposed to work, how they actually work. Think of the economy like a giant game of musical chairs. The Federal Reserve controls the music. When they keep interest rates low, the music plays fast and loud. Everyone borrows. Everyone invests. Everyone feels wealthy. But here's the catch: there are always more players than chairs. When the music stops, when rates rise or credit tightens, someone gets eliminated. The question is never whether someone will lose. The question is who and how many. For 15 years, the music has been playing almost non-stop. From 2009 to 2022, interest rates stayed near zero. Money was essentially free to borrow. This created something unprecedented. An entire generation of investors, home buyers, and corporations who have never experienced a true credit contraction. They've only known the music playing. What most people get wrong about crashes is this: they think crashes are caused by bad news. A war breaks out, a company fails, a pandemic hits. But bad news is just the trigger, not the cause. The real cause is always the same. Too much debt accumulated during the good times. When the system becomes over-leveraged, any trigger will do. If it wasn't this piece of bad news, it would have been another. The fragility comes first. The breaking point comes second. James Whitmore was a commercial real estate developer in Dallas. In 2019, at 51, he borrowed $42 million to build a Class A office tower downtown. The loan rate was 3.2%. His projections showed steady occupancy, reliable tenants, comfortable margins. Then came 2020. Remote work hollowed out office demand. By 2024, his building was 60% empty. His loan comes due in 2026. To refinance at current rates, now 6%, his interest payments would nearly double. The building's value has fallen from $50 million to roughly $28 million. He owes $42 million on something worth $28 million. There's no path forward that doesn't involve either default or bankruptcy. James isn't unique. There are thousands of James Whitmores across America right now, each holding a ticking time bomb disguised as a building. Here's a question worth sitting with. If everyone knows that low interest rates cause bubbles, why do central banks keep using them? The answer is simple and uncomfortable. Low rates are politically irresistible. They make voters feel wealthy. They make asset prices rise. They make the current administration look successful. The costs come later, usually after the next election. So the pattern repeats: lower rates to stimulate growth. Watch bubbles form. Raise rates. Reluctantly. Watch bubbles pop. Lower rates again to clean up the mess. Each cycle requires more extreme intervention than the last. In 2000, the Federal Reserve cut rates from 6% to 1% to recover from the dot-com crash. In 2008, they cut from 5% to 0 and invented quantitative easing, printing money to buy bonds directly. In 2020, they cut to 0 again, printed $4 trillion, and sent checks directly to citizens. Each crisis required bigger medicine than the one before. Now consider when the next crisis hits. What's left? Rates are already being cut from a lower peak. Government debt is already $36 trillion. The tools are exhausted. This time, the medicine cabinet may be empty. Remember Patricia Okonkwo from Part 1. The Atlanta nurse who invested her life savings at the worst possible moment and sold in panic. Her story illustrates something crucial about how crashes actually destroy wealth. She didn't lose money because the market fell. She lost money because she bought at the top and sold at the bottom. The crash itself was just the mechanism. The real destruction came from behavioral patterns that repeat with eerie consistency. There's a rhythm to how bubbles grow and burst. During the growth phase, everyone feels like a genius. Prices rise. People who bought early brag at parties. People who didn't buy feel left out. Fear of missing out overwhelms fear of losing money. So they buy. Their buying pushes prices higher. More people feel left out. More people buy. This continues until virtually everyone who can buy has bought. Then the music stops. But here's the cruel part at the top: there's almost no one left to buy. Everyone who wanted in is already in. So when the first wave of selling begins, there's no one to absorb it. Prices fall. People who bought near the top panic. They sell. Prices fall further. More panic. More selling. This accelerates until it exhausts itself. Rosa Delgado Vance saw this pattern destroy her community. She was a loan officer in Las Vegas in 2006, 38 years old, watching the housing frenzy with growing unease. She remembers the exact moment she knew it was over. A strawberry picker, a seasonal worker earning $20,000 a year, walked into her office and asked about refinancing his $700,000 home to buy a second property. He wasn't being greedy. He was doing what everyone around him was doing, what his neighbors and coworkers were doing, what television and magazines and financial advisors told him was smart. Rosa couldn't approve the loan. He went to another lender and got it anyway. 18 months later, he lost both properties and declared bankruptcy. The system had made speculation feel rational. Until suddenly, violently, it wasn't. Now here's where things get uncomfortable. If you could see a single chart showing the total debt in the American economy since 1950, you'd see something remarkable. A line that rises slowly for decades, then turns sharply upward around 1980, then goes nearly vertical after 2000. Total debt, government, corporate, and household combined, now exceeds $100 trillion. That's roughly 4 times the size of the entire economy. The mechanism here is simple. Debt allows you to spend money you don't have yet. This pulls future consumption into the present. It makes today feel prosperous, but it makes tomorrow poorer because tomorrow you must repay what you borrowed plus interest. When everyone does this simultaneously, consumers, corporations, governments, you create an illusion of prosperity that depends entirely on continuous borrowing. What happens when borrowing slows? Carmen Reyes found out. She owned a small furniture store in Phoenix for 22 years. In 2021 and 2022, business was incredible. People were remodeling their homes with stimulus checks and cheap financing. She hired 3 new employees. She signed a longer lease. Then, in 2023, the stimulus ended. Interest rates rose. Her customers disappeared almost overnight. By late 2024, she was liquidating inventory at 40 cents on the dollar just to make rent. 22 years of building a business destroyed in 18 months. She didn't do anything wrong. Her customers didn't become stupid. The mechanism simply shifted. Easy money created the boom. Tight money created the bust. Carmen was just standing in the wrong place when the music stopped. There's one more mechanism you need to understand before we can see where this is heading. It involves something called margin debt and forced selling. And when you see how it works, you'll understand why crashes aren't gradual. They're violent. That mechanism is already active. The fuse is already burning. We ended part 2 with margin debt and forced selling, the mechanism that turns market declines into violent crashes. We said the fuse is already burning. Now let's watch it burn. Here's what most financial media won't tell you. When you hear that the market fell 2% today, it sounds like a normal fluctuation. Bad day, but manageable. What you don't see is the cascade happening beneath the surface. Hedge funds and institutional investors don't just buy stocks with their own money. They borrow. Sometimes $5 for every $1 they actually have. Sometimes 10. Sometimes 30. This leverage amplifies gains on the way up. But on the way down, it creates a death spiral. When prices fall, lenders issue margin calls. Pay us more collateral, or we sell your positions. The investor must either deposit more cash, which they often don't have, or watch helplessly as their broker liquidates their holdings at whatever price the market will bear. That forced selling pushes prices lower, which triggers more margin calls, which triggers more forced selling. This is why crashes aren't gradual. They're violent. The mechanism feeds on itself. Right now, margin debt in America exceeds $700 billion. That's $700 billion of borrowed money sitting in stocks, waiting for a decline large enough to trigger the cascade. Kevin Nakamura learned this lesson the hard way. He was a 36-year-old software engineer in San Jose, confident and analytical. In 2021, he'd turned $50,000 into $380,000 by trading tech stocks on margin. He felt invincible. His spreadsheets were meticulous. His risk calculations were precise. What he didn't calculate was what happens when everyone runs for the exit at the same time. In January 2022, when tech stocks began falling, his broker liquidated his entire portfolio in 47 minutes. He received an automated email while sitting in a product meeting. By the time he checked his account, he had $11,000 left. $369,000 gone in less than an hour. He hadn't made a single trade that day. The system made them for him. But here's the twist nobody talks about. While Kevin and millions like him were being liquidated, someone was buying. At the exact moment retail investors were forced to sell at any price. Large institutional players were accumulating positions at massive discounts. This isn't conspiracy. This is mechanism. Forced selling creates forced buyers. The question is which side of that trade you're on. Let me show you something. If you could see a chart of wealth distribution during the 2008 crash, you'd see 2 lines moving in opposite directions. The net worth of the bottom 50% falling. The net worth of the top 1% briefly falling, then rising faster than before. By 2012, the wealthy had recovered everything. By 2015, they were richer than they'd ever been. The bottom half didn't recover their 2007 wealth until 2019. 11 years. A decade of their financial lives erased. Same crash. Radically different outcomes. What most people get wrong about financial crises is this: they think crashes destroy wealth. They don't. Crashes transfer wealth. The money doesn't disappear. It moves. From the leveraged to the unleveraged. From the panicked to the patient. From those who must sell to those who can buy. Understanding this changes everything. A crash isn't a disaster for everyone. It's a disaster for some and an opportunity for others. The difference is entirely about positioning and preparation. Remember Marcus Webb from Part 1, the Cleveland electrician who moved his 401k to Treasury bonds in January 2008 because his brother-in-law was getting loans he shouldn't qualify for, while his co-workers lost half their retirement savings. Marcus lost nothing. Then he bought back into stocks in March 2009 near the absolute bottom. His $400,000 became over $2 million by 2020. He didn't have insider information. He didn't have a finance degree. He simply recognized a pattern and acted while others were still believing the experts. Now here's where we need to pause and look at what's happening right now. Not in theory, not historically. Right now. The Federal Reserve raised interest rates from 0 to 5.5% in 18 months, the fastest rate increase in 40 years. They did this to fight inflation. But rate increases work like chemotherapy. They kill the disease by poisoning the entire body. Higher rates mean higher borrowing costs for everyone: home buyers, car buyers, credit card holders, corporations, and the government itself. Diana Okonkwo runs a trucking company in Memphis. 44 years old, built the business from a single truck over 15 years. By 2022, she had a fleet of 23 vehicles, 41 employees, and a $3 million line of credit at 4% interest. When her credit line came up for renewal in 2024, the bank offered her the same amount at 9%. Her interest expense would more than double. She had to lay off 14 people and sell 9 trucks just to stay solvent. Diana didn't make bad decisions. She didn't overexpand. She simply existed in a system that changed the rules mid-game. And here's the rage-inducing part. While Diana was laying off workers to survive higher rates, the largest banks in America reported record profits. JP Morgan made $49 billion in 2023. Why? Because when rates rise, banks earn more on every loan they make. The same rate increases that crush small businesses and consumers flow directly into bank earnings. This is the system working as designed. It's just not designed for you. Pause for a moment and consider this. In 2008, the government spent $700 billion bailing out banks that had made catastrophic bets. That's your money. Taxpayer money. Those banks paid their executives billions in bonuses the same year they received bailouts. Not one major banking executive went to prison. Not one, but 8 million Americans lost their homes. The banks that caused the crisis were rescued. The families destroyed by it were not. Ask yourself a simple question: when the next crash comes, who do you think gets saved? There are 14 specific indicators flashing red right now. Not theories. Measurable conditions. The Buffett indicator at 230% higher than before any crash in history. The CAPE ratio at 39 exceeded only in 1929 and 2000. Corporate debt refinancing at triple the original rates. $1.5 trillion in commercial real estate loans, maturing into a market where buildings are worth 40% less than their mortgages. Consumer debt above $18 trillion. Credit card delinquencies rising every quarter. The SOM rule, which has predicted every recession since 1970, with 0 false positives already triggered. Leading economic indicators declining for over 20 consecutive months, the longest streak since 2007. If you could see all 14 indicators displayed side by side, each one pulsing red, you'd understand why the question isn't whether a crash is coming. The question is only when. Michael Santana saw the 2008 crash coming. He was a mortgage underwriter in California, 39 years old, watching loans get approved that he knew would default. He raised concerns to his supervisors. They told him to keep approving. He had a family, a mortgage of his own. He kept his head down. When the crash came, his bank failed. He lost his job, then his house, then his marriage. Today, at 56, he lives in a one-bedroom apartment in Riverside and works as a rideshare driver. He still thinks about the loans he approved. The families who lost everything partly because he didn't fight harder. The system made complicity feel like survival, until the system collapsed and took everyone down together. Here's the uncomfortable truth. The mechanisms that caused 2008 weren't fixed. They were paused. The debt wasn't reduced. It was transferred from private balance sheets to the Federal Reserves. The speculation wasn't ended. It was redirected from housing to stocks, to crypto, to private credit. The leverage wasn't unwound. It was hidden in shadow banking, in private equity, in complex derivatives that regulators barely understand. The next crash won't look exactly like 2008. It never does, but the underlying dynamics are identical. Excessive debt, extreme valuations, ignored warnings, then a trigger, then cascade. Remember Carmen Reyes, the Phoenix furniture store owner from Part 2. She built something real over 22 years. She employed people. She served her community. She did everything right. And when the mechanism shifted, she was liquidated in 18 months while hedge fund managers who'd bet on failure made fortunes. The system isn't broken. The system is working exactly as designed. It's just not designed to protect people like Carmen, or Diana, or Kevin, or you. What comes next won't just be a market correction. It will be a reckoning. We ended Part 3 with a statement. What comes next won't just be a market correction. It will be a reckoning. The system isn't broken. It's working exactly as designed. Just not designed for people like you. Now let's trace that reckoning forward. Not months, years, decades. Because crashes don't end when the market stops falling. That's when the real damage begins. Here's what most people get wrong about financial crises. They think the crash is the worst part. It isn't. The crash is violent but brief. The S&P 500 fell 57% from October 2007 to March 2009, 17 months. But the aftermath lasted a generation. Wages stagnated for 12 years. Homeownership rates didn't recover until 2020. An entire cohort of young workers entered a destroyed job market and never caught up. The crash took 17 months. The consequences took 17 years. If you could see a timeline stretching from 2008 to 2024, with two lines tracking the wealth of two different groups, one representing the top 10%, one representing everyone else, you'd see something haunting. Both lines plunge in 2008. Then they diverge. The top line recovers by 2012 and keeps climbing. The bottom line flatlines for years, barely moving, while the gap between them widens into a chasm. By 2024, the top 10% owns 70% of all stock market wealth. The bottom 50% owns less than 1%. Same crash, same country. Parallel universes. Let me show you what that looks like at the human level. Stephen Hartley was 47 when Lehman Brothers collapsed. A machinist in Ohio, he'd worked at the same automotive parts plant for 23 years. Good salary, union benefits, modest 401k with about $190,000. When the crash hit, his 401k dropped to $94,000. He didn't panic. He followed the advice, stay invested, don't sell at the bottom, markets always recover. And they did recover eventually. But Stephen never did. His plant cut shifts in 2009. By 2010, it closed entirely. At 49, he was unemployed in a region with no jobs. He took work as a night security guard at $12 an hour. He had to withdraw from his 401k, taking the tax penalty just to keep his house. Today, at 63, his retirement account holds $31,000. He'll work until he physically can't. The market recovered. Stephen didn't. Now contrast that with Catherine Park. She was 45 in 2008, a dentist with her own practice in suburban Chicago. When the crash hit, her investment portfolio dropped from $800,000 to $420,000. But Catherine had no debt, kept 2 years of expenses in cash, and didn't need to touch her investments. She kept her practice open, kept earning income, and methodically bought more stocks throughout 2009 and 2010 while prices were depressed. By 2015, her portfolio had recovered to $1.3 million. By 2024, it exceeded $3.2 million. She retired last year, at 61, to a house in North Carolina overlooking the Blue Ridge Mountains. Same crash, opposite outcomes. The variable wasn't intelligence or even income, it was margin of safety. This is the mechanism that turns temporary market declines into permanent life damage. If you're forced to sell assets to survive because you lost your job, because you have no savings buffer, because you're carrying too much debt, you crystallize losses at the worst possible moment. You sell low. Then you can't buy back when prices recover. The wealthy survive the storm. The leveraged are destroyed by it. And the gap between them compounds for decades. Here's a question worth asking: if this pattern is so predictable, why doesn't anyone fix it? The uncomfortable answer is that the current system benefits those who write the rules. After 2008, Congress passed the Dodd-Frank Act to prevent another crisis. It was 848 pages of regulations. It was supposed to end too big to fail. Instead, the 5 largest banks are now bigger than they were in 2008. They control more assets, make more profits, and pose more systemic risk than ever. The regulations created compliance costs that crushed small banks while barely inconveniencing giants. The system was reformed in a way that strengthened the winners and eliminated their competition. Remember Diana Okonkwo from Part 3. The Memphis trucking company owner forced to lay off 14 workers when her credit line jumped from 4% to 9%. Let me tell you where her story goes. By 2027, after the crash, we're describing Diana's remaining business will face a choice: sell at a massive loss or declare bankruptcy. She'll sell. The buyer will be a private equity firm that specializes in acquiring distressed assets. They'll pay 30 cents on the dollar for a company Diana spent 15 years building. Within 2 years, that firm will have consolidated Diana's business with 7 similar acquisitions, cut labor costs by 40%, and resold the combined entity for triple what they paid. Diana will have lost her life's work. The private equity partners will have made 8-figure returns. This isn't speculation. This is the playbook that has operated after every financial crisis for 40 years. But here's the twist that rarely gets discussed. Some people see this coming and position themselves on the winning side, not because they're wealthy, but because they're prepared. Marcus Webb, the Cleveland electrician from Part 1, who moved to Treasury bonds before the 2008 crash, wasn't rich. He had $310,000 in retirement savings. Not wealthy by any measure. But because he preserved that capital through the crash, then invested at the bottom, his trajectory changed permanently. Today, his retirement account exceeds $2.4 million. He retired 3 years ago at 58. His former co-workers, the ones who stayed invested through the crash, lost half their savings, and most never recovered psychologically. They became too afraid to invest again. They missed the entire bull market that followed. Marcus isn't a genius. He simply recognized a pattern and acted when others couldn't. Now let me show you what the next decade might look like. 2 trajectories. Same starting point. Radically different endings. Trajectory 1. Yuki Tanaka, 34 years old today, marketing manager in Seattle, $420,000 saved between her 401k and brokerage accounts. Aggressive growth portfolio. No cash reserves beyond 1 month's expenses. If the crash we're describing arrives in late 2026 and she loses 50%, she'll have $210,000. But here's the worst part. She'll probably panic and sell near the bottom, just like Patricia Okonkwo did in part 1. Assume she sells at down 45%, missing the bottom by 5%. She locks in $231,000. Too traumatized to reinvest, she moves to bonds yielding 4%. By 2034, she'll have roughly $316,000. She'll be 44 years old with less retirement savings than she had at 34. Trajectory 2. David Mensah, also 34, also a marketing manager, also $420,000 saved. But David read the indicators. He shifted to 60% cash in early 2026. When the crash comes, his equity portion drops, but he preserves $250,000 in cash. He deploys that cash systematically through late 2026 and early 2027, buying quality assets at 40 and 50% discounts. By 2034, assuming even modest market recovery, David's portfolio exceeds $1.4 million. He's 44 years old and functionally set for retirement. Same starting point, same crash, same economy. A difference of over $1 million based entirely on preparation. If you could see these two lines projected forward, Yuki's flat trajectory versus David's compounding curve, you'd understand why financial crises are called wealth transfers rather than wealth destruction. The money doesn't disappear. It moves. From the unprepared to the prepared. From the forced seller to the patient buyer. This brings us to the question that matters most. Not whether the crash is coming. The indicators have already answered that. The question is, which trajectory will you be on? The window for deciding is still open. But it's closing faster than most people realize. We ended part 4 with a question: which trajectory will you be on? The window for deciding is still open, but closing faster than most people realize. Now let's bring this full circle. Back to the present. Back to December 2025. Back to you. Everything we've discussed, the 4-stage pattern, the 14 indicators, the mechanism of forced selling, the decade-long consequences converges on this moment. Not because I'm predicting the future. No one can do that with certainty. But because the pattern has been remarkably consistent for nearly 100 years. And right now, that pattern is repeating with unusual clarity. Let me be direct about what this video is not. This is not financial advice. This is not a call to sell everything and hide cash under your mattress. This is not doom-mongering or conspiracy theory. What this is simply is pattern recognition. The same pattern that preceded 1929, 2000, and 2008 is visible again. What you do with that recognition is entirely your decision. Remember Linda Chen from part 1, the Phoenix woman who lost half her retirement savings in 2008 because she stayed the course, while her financial advisor's voice stayed calm and rehearsed. I want to tell you where Linda is today. She's 67 now, still working part-time at that garden center. Her retirement account never recovered to its 2007 peak, not because the market didn't recover, but because she was forced to withdraw funds to survive the aftermath. Job loss, medical bills, life. By the time she could start rebuilding, she'd missed years of compounding. The math never caught up. Last month, Linda watched a segment on CNBC about the market reaching new all-time highs. She turned off the television and went outside to water the plants. Some recoveries, she's learned, are only for those who could afford to wait. But here's the twist in Linda's story that matters most. Her neighbor, a retired accountant named Eugene Walsh, lived through the same crash in the same city. He'd read the warning signs in early 2008. Nothing sophisticated, just a vague sense that housing prices couldn't keep climbing forever and too many people were borrowing too much money. He shifted his portfolio to 50% cash and short-term bonds that January. When the crash came, he preserved enough capital to ride it out. When recovery began, he bought back in systematically. Today, Eugene is 81 and financially secure. He brings Linda vegetables from his garden every Thursday. They've never discussed money, but they both know why their retirements look so different. Same neighborhood, same economy, same crash. The only difference was preparation. If you could see a map of America right now with each household colored by their exposure to the next downturn, you'd see a patchwork of vulnerability. Red for households carrying high debt and low savings. Green for those with cash reserves and manageable leverage. The red vastly outnumbers the green. Most households have less than 1 month of expenses saved. Most are carrying credit card debt at 22% interest. Most are one layoff away from crisis. This isn't judgment. This is arithmetic. And the arithmetic suggests that when the next cascade begins, the human toll will be measured in millions of families. Here's a question worth sitting with. Why do the same patterns keep repeating? The answer isn't complicated. Human nature doesn't change. Greed during booms, fear during busts, denial in between. The specifics shift. Tulips become railroads, become dot-coms, become housing, becomes whatever comes next, but the psychology remains identical. We believe the good times will continue because we want them to continue. We ignore warnings because acknowledging them means making uncomfortable changes. We convince ourselves that this time is different because the alternative is too frightening. This time is not different. The mechanisms are the same, only the names have changed. Let me offer a framework, not financial advice, just 3 questions worth asking yourself. First, if the market fell 50% tomorrow and stayed down for 3 years, how would my life change? Would I be forced to sell? Would I lose my home? Would I have to postpone retirement indefinitely? Second, what percentage of my financial security depends on asset prices staying elevated? If that percentage is high, is that intentional or accidental? Third, am I positioned to survive a downturn, or am I positioned to profit from one? These are different postures entirely. The first is defensive. The second is opportunistic. Both are valid. But neither happens by accident. These questions don't have right answers. They have your answers. Remember Marcus Webb, the Cleveland electrician, who trusted his instincts over expert opinion and preserved his capital through 2008. I reached out to him for this video. He's 60 years old now, retired for 2 years, spending his mornings fishing on Lake Erie and his afternoons with his grandchildren. I asked him what he's doing with his money today, in December 2025. He paused for a long moment. Then he said, "Same thing I did in 2008, watching my brother-in-law." I asked what his brother-in-law was doing. Marcus laughed. "Buying a vacation rental in Florida with money he doesn't have. Says the market only goes up." Some patterns are older than markets. If you could see a single image representing everything in this video, all the data, all the history, all the human stories, it might be a clock. Not ticking toward midnight like some disaster movie cliché. Just ticking. Steady. Indifferent. The clock doesn't care whether you're watching. It doesn't care whether you believe in patterns or dismiss them. It simply measures the distance between now and whatever comes next. The 14 indicators we discussed aren't predictions. They're current conditions. They're facts. They don't tell you exactly when the cascade begins or how severe it will be. But they tell you something important. The system is fragile in ways that are measurable and historical. What you do with that information is entirely up to you. I want to leave you with something that transcends this particular video, this particular moment, this particular set of indicators. Markets rise and fall. Crashes come and go. Generations lose fortunes, and generations build them. The cycle continues regardless of who's paying attention. But within that cycle, individual choices still matter. Preparation still matters. Pattern recognition still matters. Not because you can predict the future. No one can. But because understanding patterns is the difference between being positioned and being caught. The crash doesn't ask permission. It doesn't wait for you to be ready. It arrives on its own schedule, indifferent to your plans. The only question is whether you'll be among those who saw it coming.